Hey, Puppy Trades! I wanted to do a video analysis update on the pending crash. Yes, the pending crash that I believe is coming in bond yields. Yes, I believe bond yields are about to crater. I think we saw the start of that today with TLT being up 1.17% on a negative, or I think a flat day for SPY at least. That kind of divergence is a little interesting. And looking at the chart of TLT, some of the unusual options volume on long-term bond ETFs, investment grade bond ETFs, they all kind of send a similar Elliott wave message. And so the Elliott wave is clear, but for the broader investing aspect of my life, I do remember that, and I do diversify with various bond ETFs. I like to blend my favorite investment grade bond ETFs with LQDW, running the buy right on LQD. I own HYGW, and I own ETFs like COOZ that are collateralized loan obligations, and THTA and HIGH from SoFi and Simplify that own 3 to 6 month treasury bills and then sell credit spreads against them to enhance that yield. So I do remember, though, that the last time TLT hit an all-time high, that was in the pandemic, March of 2020. So a major crisis happened, and we saw the value of bonds explode. So for diversified investors, that was very good because while the stock market was crashing at that absolute peak, the value of their fixed income holdings, which might be 40% based on the 60-40 ratio, exploded. And then as the bonds went down, we've seen an explosive rally in the S&P 500, not perfectly correlated. And so bonds and the S&P, they're not perfectly correlated. That's the whole point of diversification. But in the back of everyone's mind, everyone kind of knows that if bonds have an explosive move, it's going to affect the rest of the market. It's particularly going to affect growth stocks. So I've talked about the Elliott wave of some growth stocks, and there is just an interesting theme that a lot of these biotech stocks, a lot of these software stocks, and a lot of these e-cash stocks, the fundamental explanation that they had for their explosive rallies was the aftermath of the pandemic. So again, bond yields go up because of a crisis. These growth stocks go up because of a crisis. So this is a wave one in an ABC, I believe, for PayPal. So I bought PYPY before the ex-dividend date, and I believe this is another wave one in an ABC wave two at the 61.8% retracement. I'm looking for the length of wave one placed at the wave two low at minimum to be a wave three target, and that's going to just be the wave three target before a shallow wave four and a wave five higher. So I'm looking for PayPal and Shopify both to begin wave three of wave three, and so those are various growth stocks. Moderna I own. I've talked about the biotech stock recently, the biotech ETF in my last video. I've talked about why I own Opco Health. Some of these smaller cap ones. I still own Leap on Co-Diagnostics, waiting for that one to get started. And so there is kind of that aspect that in conjunction with these Elliott wave counts and growth stocks, particularly the Elliott wave counts and growth stocks like Shopify, PayPal, and Moderna, where they have had two interesting correlations with bond ETFs. On the one hand, their explosive rallies both had the same explanation in 2020 and 2021 with the pandemic, and also we see this pretty interesting correlation where during that rate hiking cycle, while TLT was falling, while IEF was falling, all the bonds were following during the rate hiking cycle, we saw the growth stocks fall significantly. So there's this obvious explanation that the Fed could simply just start cutting interest rates, and that would be the explanation for why not just these stocks but various stocks in the market, wave one, ABC wave two, wave one, ABC wave two for Shopify, could unfold and lead it higher. In the financial sector as well, we've seen a recovery that I've predicted for stocks like SCHW, Charles Schwab, as well as for Ally. I believe both of these stocks are going to, round out the base, and essentially that they're leading a recovery in the bonds, and not just the bonds, but this is Ally, another financial that I predicted would enter wave 3, start heading up to this side of the base. I perfectly predicted that JP Morgan would do that as well. That's been the ultimate leader in financials. So, I'm expecting, that the financials are going to keep, following one by one. JP Morgan, it's really had a absolutely crazy rally. But anyway, back to bonds. I think that it's pretty clear when that rate hiking cycle happened, it was clearly correlated with a fall in growth stocks and also the real estate sector and also the utilities sector. So we see bond yields start to crash. Looking at the Elliott wave counts of these various sectors, the other one that I was going to do was real estate. We saw real estate go down during this hiking cycle as well. This is SCHH. It has a very similar count to the bond counts we're going to go over, that this was 1, 2, 3, 4, 5, wave 1, an ABC wave 2, another wave 1, and a wave 2. So real estate is something that I prioritized because I believe real estate is going to rise, and similarly that real estate yields are going to crash, just like I believe bond yields could be going down significantly. So for retirement purposes, that's very important because each of these sectors, besides the growth, these stocks, by the way, the growth stocks, they do have ETFs that I buy, MRNY and PYPY, that pay dividends. But besides that, all these other sectors that I've talked about, the bonds, the real estate, utilities, we've seen that they're the big dividend payers. And so when their yields fall, they might be gone for a long time, a long time. So in the long term, I think this is the 10-year note. I'll give the long-term picture with this one. I think this is a 1, 2, wave 3, an ABC wave 4 correction, and a wave 5 higher. That's a large wave 1/wave A. And this is an ABC wave 2 correction that ended at the 61.8 to 78.6% fib. It ended at the 61.8% retracement. So I believe that in the long term, that we are going to see the 10-year is going to hold. Well, I'll give the better invalidations with these other bond ETFs. But I think this is the 1, 2, 3, 4, 5, wave 1, wave A, wave 2, wave B. And this wave 3, wave C is eventually going to take the value of 10-year bonds up to a new all-time high, the 140s, the 150s. So looking at some clear accounts from these other bond ETFs, this is TLT. From the short term, I believe this is a 1, 2, 3, 4, 5 wave 1, an ABC wave 2, and then from this low, another wave 1 and another wave 2 has formed. And that this kind of wave 3 got in progress today with this big outperformance, this big 1.17% move, and we could see TLT go the length of wave 1, place of the wave 2 low, up towards 105. Then it would have a shallow wave 4 correction, and Elliott wave 3, wave 4 retest the wave 1 high. Then wave 5 is the length of wave 1, place at the wave 4 low. That gives a wave 5 target of about 118. So that would be a pretty significant collapse in bond yields if TLT did that. This is an index of long-term bonds from Vanguard, almost identical count, 1, 2, 3, 4, 5, wave 1, wave A, and ABC, wave 2, wave B. And then from this low, another wave 1 and another wave 2. This also outperformed significantly. So investment grade bonds, this wasn't an investment grade bond ETF, but that's TLT. That's TL. That's the 10-year note. This is right here an investment grade bond ETF. These are interim term bonds. They're not long-term bonds. The last ETF was a long-term bond index from Vanguard. This is a bond ETF with intermediate terms for investment grade bonds of 5 to 10 years. So really, as long as the company which has investment grade quality based on Moody's and Fitch and the other rating agencies, as long as they've got their debt settled, their debt's going to be able to be paid for the next 5 to 10 years, then this ETF is going to keep paying dividends, and that's going to be a 4.11% yield from these really kind of high quality bonds. And so this is kind of an opportunity, in my opinion, that's going to dissipate. It's going to go away. And whether or not there's some dramatic story behind it in the world, and whether or not the growth stocks rally with them, each of them for their own fundamental reasons, I still think that when I look at portfolio construction and risk management, having fixed income in there is something that I value. So when the yield of that fixed income runs away, looking at these long-term charts, it could be on a runaway train, and they'll never look back. And so, that's a song I'd be listening to all night. You might even want to go watch that Always Sunny in Philadelphia episode where they sing, I think where Dee Dee sings, runaway train, never go back, something like that. These bond yields, in my opinion, they're about to crash, and they're gonna go on a runaway train. And so when I really think about serious portfolio construction, I do invest in bonds, I invest in real estate, and I invest in bond buy right ETFs like LQDW, HYGW. I invest in THTA, and I invest in CLOZ. Those are some of my favorites. I also invest in RQI for real estate, and there's a lot of ways to get exposure to real estate. But these really high quality bond yields, this really high quality fixed income for the 60-40 sector, these sexy growth stocks, they're gonna do what they're gonna do, get the capital gains, and that's gonna be great. That's why I get the synthetic covered call ETFs and collect those dividends, because that, once those capital gains are gone, those capital gains are gone. But the dividends, they're forever, and they're not as exciting or as fun. But when the landlord and the car insurance company, when they call, I'm really glad that I have safe, stable dividends in those accounts, and those yields on those dividends for those underlying ETFs, I believe they're about to dissipate. They're going to go on a runaway train, and they're never going to look back. So I'm looking for, me to be singing some sad songs, but also collecting some big dividends from real estate, from bonds, but also from growth stocks like Moderna and PayPal that have synthetic covered call ETFs that I can buy on them.